I firmly believe we are on the edge of a pullback in the market. I'm going to show you why. I'm going to talk all about that. But of course, we're going to let Tom Nash, one of the friends of the channel, tell us why he thinks that there is an important warning to all investors. And I'll jump in with my opinions as well.
We are actually about to cross from greed to extreme greed on the fear and greed index. Of course, it doesn't mean.
Well, since he brought that up, let's jump right over into the SPY. That was not planned. Clearly, I would have had that up already. But where are we at on the SPY? That's meta. SPY. We're trying to see how deep in the greed we're going. And that's one of the things that OVTLYR measures, is not just, the performance of all these stocks, but how deep in the fear and greed they are. So we can see SPY has been going up for a hot minute. It's now at 81.11. If we zoom out a little bit, let's go to the 6-month viewpoint. The higher up we get, the more likely we are to see a snapback in price. Now, it really went sideways from this peak up here where it was around 82 to around 56 on the fear and greed. And then it started peaking back up after that. But if we look way back here at the beginning of 25, where the market sold off for months at a time, the fear and greed was actually, it peaked at 67, and it came down quite a bit. The fear peaked at 27 and then came up after that point. So if history is anything, right, it doesn't necessarily mean that we are due for a snapback specifically on this. But I'm seeing cracks under the surface in market breadth. And let me show you what I mean by that. I'm sure Tom will cover all that, by the way, but I'm too excited. I got to share it right now. The thing that I'm seeing, right, is first, we got this bullish crossover on market breadth. This is how many stocks are getting buy signals. And of course, that's what we want to see. I will not trade unless I have bullish market breadth behind me. But not even one day later, we started having a weakening bullish trend. 2 days later, we're back now crossed under in a bearish fashion. Not only that, but if we look at how many stocks have uptrends versus how many stocks have downtrends, while that was moving in our direction in one single day, since that point, more downtrends are showing up, less uptrends are showing up, right? So the reason that this matters is that we need to have all of these market participants in confluence with us, right? We want to have as much ammo in our pocket, I guess you could say, to push the market higher. And if we're getting less buy signals, more downtrends, less uptrends, that's not going to help anybody. Not at all. A rising tide lifts all ships, and a rising tide especially lifts the market up. But I think we're due for a pullback, and that's some of the reasons why. Let's see what Tom has to say here. Now, then again, we don't use this fear and greed. That is a completely different measurement in what we use. So, of course, it's going to read a little different than us.
You have to sell out of your portfolio and go 100% cash. That's not the point of this video. But on the other hand, if you completely ignore that and just become an ostrich and absolutely don't do nothing, well, in that case, you might get hammered just as bad. The idea...
Tom. So for those of you who don't know, Tom and I have had a few conversations in actual real life. Well, through the internet, through the Zooms. Bro pulled out monkey hammer. I appreciate that. Thank you, Tom.
Here is not that we're going to sit here and never take any risks and just play it safe. In that case, you can just sit in the money market account, right? Or get a bond.
Bro watches our channel. Yeah, Tom is listening. Bro just literally said, you could go sit in cash and don't F up.
The idea here is we want to take risks, but we want to take calculated risks, and we want to mitigate the risk as much as we can. That's the mantra that I teach in the academy, and that's what I'm about to talk in today's video. Now, again, we are currently at very, very hypey times. A lot of hype, a lot of FOMO, a lot of excitement, a lot of participation by the retail investing community, which is good. It's not a bad thing to have retail participate in investing. Actually, it's very, very healthy. But when it gets to the point of the shoe shine boy example, when you have your shoes shine and then the shoe shine boy is asking about Palantir, well, in that case, you should start to get concerned and you start to mitigate your risk.
Yeah, and I've also felt that way. We definitely feel, at least in my opinion, that we've come back to the meme stocks age. And I want to show you, there's a site that I use every once in a while when I'm doing some research called Ape Wisdom. And what's cool about this is it'll show you what stocks are trending all Wall Street bets. So United Healthcare, AMD, Nvidia, Open Doors, SoFi, right? We are seeing more and more meme stocks like Open Door. Come at me in the comments like SoFi. SoFi is a meme stock. I'll take it to my grave. And And then hymns, right? There's been a lot of these types of meme stocks. The excitement lately has been off the charts. And if we go to the SPY, right, we've been seeing, new highs day after day after day, which is wonderful. This is what you want to see in a bull market. Finally, it might be a first down day in a hot minute. And I'm definitely not calling for a crash, but I can definitely see a little short-term pullback coming here.
Of course, it doesn't mean the stock market is about to crash tomorrow, but it also means that, the world works in very cyclical ways. Back in 2017, I was in the kitchenette of a place to work with. And in the kitchenette, I had a really lovely conversation with this older lady who was kind of the office manager. And she told me, look, I've never invested in my life. And I just bought my first Bitcoin. I'm very, very excited. And I remember looking at the price of Bitcoin was $18,000. And I told to myself, this is the beginning of the crash. The crash for Bitcoin is coming. And literally a few weeks later, Bitcoin went down all the way down to $3,000. Now,
But, to his point, that's so real, right? When you start hearing family, friends, relatives, acquaintances giving you investing tips, generally that is the top. That really is. It's proven itself over and over and over. And I think Tom's saying that right now, right? If you look at one of Tom's favorites, Palantir, right? Palantir, which can only go up, only goes up. Palantir only goes up. I know it's got all kinds of notes over exactly. I know, but Palantir only goes up, right? Right. People said that about Tesla too a few months ago, if you remember, when Tesla went up 100 and I think it was 124% up, and then that 100% evaporated after that point, right? This is the market cycle. This plays out over and over and over. And I'm not saying that that's going to happen to Palantir, but it certainly looks like it. If you could see through all my notes, it certainly looks like it.
I've never had Bitcoin in my life, so I was just having popcorn on the sidelines. But when you have all this hype, all this FOMO, it's really prudent to be careful and mitigate and be smart about it. Now, one of the best one-liners I've ever heard about investing is that in bullish cycles and bullish times, investing horizons, they stretch out a lot, right? But when times get tough and when we're going through bearish cycles, then investing horizons, they tend to shrink. So people have a lot of comfort in being a 10-year investor when things are going great, but when they're looking at a 60% drop in their portfolio, they become very short-sighted, and that's just part of human nature. Now, we're going to drop the soapbox here. We're not going to be talking about, oh, boo-hoo, boo-hoo, boo. That's not the point, right? We dollar cost average. We buy good companies. None of this really matters for us as far as selling and buying. We're not going to time the market. So none of us here in this academy, in my community, is going to be trying to exit the market just before the crash because, as Peter Lynch once said, there's...
I will. I'll be glad to. In fact, that reminds me of when the SPY was down 20-something% at one point, and I was screaming into my bullhorn, you don't have to hold stocks as they're crashing down. Buy stocks as they're crashing up, not as they're crashing down. AMD, perfect example. AMD is such a wonderful example. I love AMD. So what? Chris loves AMD? I do love AMD because it's a beautiful example of when not to buy a stock versus when to buy a stock. And I know all the people are going to be saying, well, Chris, you got a dollar cost average on the way down. That way you make more money on the way up. Here's the crazy thing. I've shown you this a handful of times, but if you dollar cost average and buy here, here, and here, right, at whatever different points you want, your average price will be exactly the same if you're buying it on the way up versus on the way down, considering if you bought the same number of shares, because it's just math. The issue is if you're buying it on the way down, you don't know how far down it's going to go. But if you look at it here, when the 10's over the 20, price is over the 50, that crossover point happened on May 7th. Look at what happens when you buy it in an uptrend versus look at what happens when you buy it in a downtrend. And for this example right here, you'd go from November to June before you break even. Versus buying it here, you're at profitability almost right away. Yes, I will tell you, you do want to time the market. Will you be perfect? No, of course not. You're not trying to be perfect. You're never going to catch the bottom 10%. You're never going to catch the top 10%. But that 80% in the middle, that big juicy brisket sandwich that you just ordered with this all saucy right there, a little bit of pickles, a little bit of onions on it, the meaty part is what you're here for. You're not here for the buns, right? Mrs. Baird's bread can go take a hike. I just want the bun to be gone because it's in the way. The bun is just a vessel to put the meat in my mouth, right? It is nothing more than putting it from hand to mouth. And the same is true in trading, right? You're never going to catch the top. You're never going to catch the bottom. You just want that meaty 80% in the middle. And you can time that by using the outlier trend template with the 10 over the 20, price over the 50.
More money lost and waiting for correction than the corrections themselves. That's not the point. The point is that you do have strategies against FOMO, and you do have strategies to mitigate the risk of whatever it is that is possibly coming, because the cycle is always the same. I've showed it a million times before. We have optimism, then greed, then fear comes back when this thing crashes. So it's a cycle of, you know, you go.
I have not watched a Tom Nash video in a minute, but this son of a gun, I know I didn't make this slide, but boy, do I like to show it. Boy, do I like to show this slide. In fact, I believe I have that slide with a little bit of notes that I made on it. Hang on, ignore that slide. That was from earlier. This slide right here, right? Taking that slide, figuring out where we are in the market cycle. Stage 1 is the sideways capitulation. Stage 2 is the big, beautiful uptrend that everybody wants. Stage 3 is the top, where a lot of people are trying to get in. And then stage 4 is the downtrend, the anxiety, denial, panic. I haven't brought this chart up in a minute, but it's so fun to see our friend Tom Nash, friend of the channel, also using the exact same chart.
Going up, you're going down, you're going up, you're going down. The market's going to do its thing, right? But overall, over the period of the next 5-10 years, you know, the good companies, they're going to do better and better and better. So how do we use?
By the way, as funny as you're joking about this, we've had Tom watch us live and interact with us live. So who knows? Tom may be here too.
Use the upcoming correction, whether it's in 2 days or 2 months or 2 years. How do we use that the market is about to, you know, punish all the FOMO seekers and, you know, shake out a lot of the retail, whether it happens in 2 days, 2 months, or 2 years, I don't care, but at some point it's going to happen. So how do we use that in our advantage? And the answer is quite simple, right? Number one, in case you haven't kind of had this conversation with yourself, you should. And the conversation is very, very simple. Number one, how much of a downturn are you willing to accept in your portfolio, right?
I think that's a great question to ask yourself. For me, I want to have as little of a downturn as possible. Now, I would want the same for you, right? You're never going to get, you know, every single day you log in is not going to be higher than the day prior, unfortunately. And for me, right, I had a little losing streak, and so I'm in a bit of a drawdown. I'm still up, you know, I think it's 24% for the year, even though I was up at 60% for the year at one point. That's part of the game, right? And I know that once I start trading again, once I stop sitting in cash and, you know, start effing up, I guess you could say. No. Once I stop sitting in cash and start trading again, of course, it's going to stair step higher. I don't know how high, and that's not for me to decide. That's for the market gods to decide. But you have to have that plan. And part of that plan is making sure you're willing to know how much you're willing to take whenever you put on a trade. Like for me in AMD, there's no way I would hold it. There's no possible way I would hold it down like this. However, yeah, I'd hold it like crazy as it's going up. Let's look at Palantir, right? If Palantir is moving up like this, right, that's a great stock I would love to own. But if Palantir contracts like this, a big, ugly sell-off, I don't want to hold that because I don't know how far and deep that's going to go.
If you have made a lot of money investing in great stocks over the past 3 or 4 years, and now you're sitting on a very nice pile of unrealized profits, meaning that you've never tasted the money yourself, how much of it you're ready to see down? 50%, 60%, 70%, right? So if you're not ready for that, you might want to consider to trim 10%, 20%, maybe even 30%, maybe even 40%. It's a personal decision. And when you trim a little bit, then you basically have insurance against a potential correction or a crash.
That's interesting. I disagree. And you know, of course, everybody has their own style, and I appreciate Tom sharing his style. And you know, who cares what I have to say? I'm just a random guy on the internet. I like to go either my full position in or my full position out. I don't ever trim in or trim out. But that's just me, right? I like to be lump sum invested in or out.
But you're still participating in investing and you're still participating in the game. Now, What we sometimes do in the academy, and this is again a personal decision that everybody has to do for themselves, when we have a specific stock, or in the case of the overall market, let's say the S&P 500, when it is running out of control, and you can set your own definition of what is running out of control is. Up 10% in 30 days, up 20% in 30 days, whatever threshold you choose for yourself. But whenever we have a stock or an index flying out of control, we as dollar cost average investors, meaning we invest at all times, we slow down to half speed and we remain at half speed. And
oh, that's interesting. Investing at all times. There's no reason to invest at all times. Let's go back to Tesla. I know Tom's a big Tesla bull as well, right? You actually can just invest on the way up and then not hold it on the way down and then invest it again on the way back up. And in fact, I would bet, I would bet quite a couple dollars there that you would have more money by buying it when the 10 is over the 20, price is over the 50, than getting out and then doing it again and then getting out versus riding this all the way up and down. I'm just guessing. I think the math works best when you're adding, not doing anything, adding, not doing anything, versus watching go all the way up, all the way down. Yeah, I don't know. Just my opinion.
Until the thing cools down a little bit. So just the same way as we're doubling down when the stock drops below the threshold, if the stock goes up above the threshold, we slow down and we still DCA, but we slow it down a little bit and we're a little bit more relaxed because we want to buy more when there's blood. We don't want to be buying more into a parabolic spike, right?
Oh, I disagree completely. And that's what's great about the market. Everybody has their own opinion. And back to AMD. Why would you want to be buying it as it's going down? Why? You don't know when that's going to stop. You don't know when the bleeding, if we're going to talk about blood, the cut has been made. At this point, you're bleeding out. You're bleeding out all over the place. And every time you buy more, you're adding to the bleeding, right? You're not applying pressure, but you're like squeezing it out like a roll of toothpaste, I guess you could say. All the blood, there's blood everywhere. Okay, blood everywhere. Versus buying it as it's going up, even you can still dollar cost average, right? And you'll still get the exact same price. If you said I'm going to buy it at 130 and 120 and 100, doing the same thing up here, you're going to get the same price. It's just math. Yet, you don't have stress. Right? You get to keep all that hair on your head. You don't have to lose sleep at night. Like, how far down is it going to go? Versus, oh man, this is great. Let me just dollar cost average on my way up. I don't know. I mean, I don't listen to anything that I say. Doesn't matter.
Thing here is very, very simple. If you are sitting on a huge amount of profits, trimming a little bit is just responsible, and it's actually going to help you a lot in dealing with a correction when it happens. Number two, slowing down your DCA in case your stock is flying like crazy. Also a good opportunity to actually utilize the way DCA is supposed to be. DCA is where you buy at peak on the bottom and very, very slowly at the top. The main thing to do over the course of the next 6, 12, 18 months, however long it takes for this correction, which is inevitable to happen, is just to ignore the noise. Try to not focus too much on macro. Eventually,
I agree with that. Ignore the noise, right? Just follow your own trading plan.
There's going to be some reason, whatever that reason is going to be, that's going to start the process. It's going to be the fuse that's going to ignite the correction. When that happens, I don't know. And I have no idea what it's going to be like. But to try and listen to short-term noise is just bad. People thought that fuse is going to be lit by tariffs, right? And we had the tariff sell-off back in April, and now everything is up and then some. So if you gambled and you bought, and then you sold out just because of the tariffs, because you said, the tariffs are going to collapse the market, you've missed out on a huge rally. And
actually, on a slide that I stole from Tom, funny enough, this slide right here, I literally screen capped this right off the video. You can even see like the YouTube like scroll bar down at the bottom. There's always a reason not to be in the market, literally always. And the market has gone up for many, many years. There's always a reason. But if you follow your trading plan, it's all noise. In fact, I remember specifically in early May, it was a Friday, put on all my trades because that was the first trades I think I put on before May 9th. I think I put on 3 total trades for the whole year at that point. The rest of the time I've been sitting in cash. May 9th, through May 14th, my account was up 30 something percent. I mean, in one calendar week, my account went up 30 something percent. And I remember specifically all the people on YouTube's watching this and all the comments and stuff being like, Chris, you can't put this on tariffs. There's so many bad things happening out in the world. And there really are. But there's always a reason to not put on trades. But you've got to follow your plan. And listen, if your plan is to just, be scared of everything and never put any money into the market, then that's your plan. Not for me.
So just the same way as I'm saying, don't time the market also means not to try and time a correction. Because a lot of people say, well, Tom, if you're saying that the correction is inevitable, why not sell now ahead of the time? Because,
I think this is a very valid question. Why are we even comparing the two? Well, in my opinion, investing and trading are the same thing, right? The objective here is following a trend for both of us when the trend is trending up, okay? Facts. You're only going to get paid when the trend is going up. In my opinion, the difference between an investor and a trader is an investor will throw money at a stock in the hopes that maybe one day he'll come to profits, right? For example, from November to July before they get to profit. A trader looks at it objectively and says, okay, the path of least resistance in this case is up right now. Do we know how far it's going to go? No. But my goal is to make money. So is his goal. But my goal happens to be in the profit faster than buying it on the way down. Am I saying it's better or worse? No. We have the same objective at the end of the day, which is to have more money in our account than we would have had otherwise. I just feel like if you're going to go about it, why not do it in the least risky way possible versus setting your money on fire and hoping that it burns itself out and then starts to grow?
That this might happen in 2 days or 2 months or 2 years, I don't know. And if we have another 10, 20, 30% on the S&P 500 before it actually happens, you're going to miss out. The market can be really, really irrational in the short term. The market can be irrational longer than you can be solvent, actually. So my thing to you is...
Yeah, the old adage there is the market can stay irrational longer than you can stay solvent. And I have a great story about that, in fact. If we go back to Tesla, I remember there was a few years ago, there was this particular person on Twitter, and I don't know who it was. I can't remember his name off the top of my head, but it was somebody that I followed at the time. And I remember specifically, it was somewhere like in this 2020, 2021 timeframe on Tesla, and putting out this public tweet telling Tesla, you know what, this has gone far enough. I am launching the biggest short position I ever have at this point. And I looked at it and I was like, this dude must hate money. This dude must literally think that money is the worst thing on God's green earth because he's just setting it on fire. He doesn't want any of it. And what do you think happened, right? Surely he closed his shorts. But the point is that, like, if a stock is moving in one direction, move with it. And that's true in both directions, right? If it's moving down, you don't have to move with it. If it's moving up, you can buy it and hold it. And if it's moving sideways, sometimes you might make a buck or lose a buck. But you can keep all the gains on the upside and completely skip out all the gains to the downside. But long-term investors don't want to admit that. And I don't understand. I don't understand why. I legitimately don't. My itty bitty baby brain cannot comprehend why you wouldn't want to do that.
If you haven't yet, learn the system, learn the process, how to operate in very, very tough times, both in the bear cycle and the bull times. Because I think that FOMO and panic, they're equally as hard for a new investor. Now, what you got to do is you have to work out a system, how to dollar cost average, what are your rules, where's your goalpost, how not to move your goalpost, how to deal with this emotionally, psychologically, logically, how to put a team around it that's going to help you and prevent you from making mistakes, how to be a part of a group that actually helps you make the right decisions. And for that, I offer, once again,
OVTLYR.com for only 82 cents a day. I thought that this was going to be a little bit more market analysis. I'm not really sure what he was trying to say here. Tom, if you happen to watch this, let's hang out again, bud. Tom and I were actually planning to do a daily show together. Like we had actually reached talks to where that was going to happen. And Tom kind of ghosted me at that point. So Tom, maybe we can rekindle this relationship here, my friend, because we could definitely do something great. So anyway, I feel like there is a potential for a short-term pullback. Maybe that's what Tom was saying as well. The SPY is down 40-ish basis points today. The SPY is crashing to levels not seen in 2 days. But really, you do need to follow the data. Don't rely on opinions, and definitely don't rely on random guys on the internet like me. But I do need you to listen. If you want to save time, make money, and start winning with less risk, there's 2 videos right here, and you should watch one of them. You should have a fantastic day. We'll talk later.